Someone asked me, how does the rate cut by Federal Reserve affect the stock market, the ETFs, commodities, bond market, and real estate? And I'll cover all of this in the video, and I will try to keep it simple so that anybody who do not even have any economics or financial background can still understand. When the Federal Reserve cuts its key policy rate, it's like they're lowering the price of borrowing money. So imagine if a bank suddenly told you, hey, we'll lend you money, but now we're charging you less interest. So this makes borrowing cheaper and spending or investing more attractive for businesses, people, and even the government. So here's how this ripples through different parts of the market. Let's look at the stock market. For example, S&P 500, ETFs, and index funds. Businesses can borrow money cheaply. They're more likely to expand, build factories, hire workers, or develop new products. Investors then think these companies might make more money, so their stock prices might go up. So let's say you own an S&P 500 ETF, which includes shares of big companies like Apple and Amazon. If these companies grow because of cheaper borrowing, your ETF might also increase in value. Okay, now let's look at how it affects commodities such as gold and oil. Usually people see gold as a safe haven when the economy is uncertain or when the value of the dollar is weakening. Lower interest rates usually weaken the dollar because it becomes less attractive to global investors. So gold prices often rise when interest rate falls. Think of gold as a safety net. When rates drop, more people want that safety net just in case the economy slows. For oil, cheaper borrowing can boost economic activity. So it can lead to more demand for oil. Like, factories are running longer, there's more transportation needed, there might be more cars on the road, and all of this could lift the prices of oil up. Now let's look at the bond market. When interest rates drop, bond prices tend to go up. Why? Bonds pay a fixed interest rate like a promise. If the Fed cuts rates and new bonds start offering less interest, your older bond paying a higher interest suddenly looks more valuable. For example, imagine you have a movie ticket, right? And now prices for those new tickets double. Your old ticket is suddenly in high demand because it was cheaper. Okay, now what about yields? Lower rates mean lower yields on new bonds, which makes the existing bonds more appealing. So let's put it all together. When rates drop, stock market often rise because businesses have cheaper money to grow. Gold might climb as people hedge against a weak dollar or uncertainty. Oil could rise because cheaper money fuels economic activity. And bonds gain value, but the returns on the new bonds will go down. So to summarize, a Fed rate cut is like turning on a money flow tap. It makes borrowing cheaper, it encourages spending and lifts some part of the market while shifting money into others. It's all about where investors think they'll get the best bang for their buck. Now let's look at the impact on mortgage rates. So here it is. Important to know that mortgage rates aren't directly tied to the federal funds rate, but they're still influenced by it. And let me explain how this works in simple terms. So how are mortgage rates set? Mortgage rates are mainly influenced by the bond market, especially to the 10-year treasury bonds. When investors buy lots of treasury bonds, their yields or returns go down and mortgage rates will follow them. When investors sell bonds, yields go up and mortgage rates rise too. So how does the Fed come in this picture? Even though the Fed doesn't directly set mortgage rates, its actions indirectly influence the bond market. When the Fed cuts rates, it signals that borrowing will now become cheaper. Investors may shift their money into safer investments like bonds. As demand for bonds rises, yields drop, and so do mortgage rates. So when the Fed raises rates, borrowing becomes more expensive. Investors may sell bonds for riskier assets, pushing bond yields up, and mortgage rates often rise too. Now, let me give you an analogy. Think of a federal fund rate is like a thermostat in your house. The thermostat doesn't heat the house directly, it just controls the furnace. The furnace then heats the whole house, including your bedroom, which represents mortgage rates in this case. So why aren't mortgage rates always in sync with the Fed? Mortgage rates are also affected by inflation. If inflation is high, mortgage rates rise even if the Fed is cutting rates. That's because inflation erodes the value of fixed rate investments like mortgages. Supply and demand for bonds also play a role. If demand for bonds drop, for example, investors want higher returns elsewhere, yields and mortgage rates can go up. The third factor is if people think the economy is shaky, they flock to bonds, which lowers yields and mortgage rates. So to sum it up, the federal funds rate doesn't set mortgage rates, but it creates a ripple effect in the economy that eventually influences them. It's like throwing a stone in the pond. The splash, which is the Fed's decision, sends the wave, which is the bond yield, and this affects the mortgage rates. So when the Fed cuts rates, mortgage rates often drop, but not always, because other factors like inflation or market conditions can get in the way. I'm an economist. I hope this explanation helped you. I know it was a lot, but I still wanted to talk about all of these because somebody had asked me the question. So I will see you in my next one. Take care. Bye.